Good afternoon from the floor of the CME. This is Chris Robinson with your Traders Exclusive comment for today, Wednesday the 13th. Well, we're into the last couple weeks here of December, and I'm going to focus on the grains very quickly, a little bit on the livestock, and then wish you guys a good day. First off, we survived the USDA report. Everybody was looking for some sort of big news. At the end of the day, the information that the USDA gave us certainly was not bullish. Wasn't terribly bearish, but certainly was not bullish. The market responded. How so? Well, we'll start with January beans. January beans, after 10 days ago, making a 5-month high, having a lot of new money come in on the long side in the fund market, both in beans and soybean meal. Those guys are kind of stuck now because now we've dropped back down about 35, 40 cents after making those highs. So we're right at a key support level. One thing I should talk about if you're new to trading or just learning about it, the longer term trend lines, 100-day, 200-day moving averages. Those are things that I think that most people, unless you're day trading, you really want to look at the longer term moving averages. So coincidentally, pull up a chart of January beans. We're right up against a 200-day moving average. Why is that significant? Well, most of these trend following programs, they don't do like day trade all day long. They're not doing the Autobot trading. They're more looking to try and catch the overall big moves. So because of that, these longer term trend lines are very important. Take a look at that. January beans right on the 200-day moving average. If we were to fall below that, that might be a trigger for the managed money to start cutting losses. In other words, selling the long positions they just built up 10 days ago. And that's really the essence of trading. You take a stand, the market doesn't reward you. You have two choices. You can hold it and hope for the best, or you cut your losses. And cutting your losses, your 95% of successful trading is about cutting your losses when you're wrong. So I would watch that level moving forward, the 200-day moving average in JM beans. Corn and wheat, again, the market is well supplied, not only here in the United States, but worldwide. We had fresh contract lows and fresh lows for the move for both wheat and corn. It's going to take a South American weather issue between now and the end of March to get us really going here. We need an issue. Either we need too much rain or not enough rain in South America. Right now, the market's there's no real weather premium built in there, and that's really the one thing that we can look for if you're looking for a bounce in the markets. The managed money has added to their shorts. They're short over 200,000 contracts of corn, probably close to 150,000 contracts of wheat now. So they're leaning on the market. If they get a reason to cover it, we could rally back sharply. Until then, it may just be a continuation of the kind of lackluster, dismal trade we've had all 2017, where we get a little bit of rallies and then we fall back. So it's been a disappointing year for certainly for bull traders in the grains. We'll see if 2018 can turn it around for us. Again, what's it going to take? It's going to take a weather issue. Then very quickly, what's going on in the cattle market? Well, if you've been watching me every week or every other week when I do these reports, I talked about the fact that we'd had a great rally really year to date in fat cattle, which is the live cattle, and feeder cattle. It didn't take very long for us to give back a big chunk of that. Even if you just start from the August lows, we've given back a pretty big chunk of that rally. And typically you see that. It takes 5 months to rally 25 bucks. We rally 16, and then we lose 16 or 17 of that rally in about 6 days. So the old analogy holds true. You rally up the escalator and we correct down the elevator shaft. Now, cattle right now is very oversold. The managed money, however, is still sitting on a big long position. We'll get a fresh commitment to traders report on Friday. We'll see if they've sold a chunk of their longs, but they had come in. They were long about 17,000 feeders. They were long about 120,000 contracts of live cattle. If these guys need to rebalance, or if they decide that they want to flip and get short, there could be some more downside risk here. $6, $7, $8, $10 worth of downside risk if they decide to sell these positions, because who's going to buy it from them, right? If you know somebody's stuck, you're going to, if you need to buy cattle, you're going to fold your arms and wait because, you know, the market's falling. So that's the level we're looking at. Looking for movement, I would say between now and the end of the year, I'd probably focus more on cattle than really on grains. Again, the grains are really dependent on what happens in South America, whether this next 3, 4, 5 months. From the floor this evening, this is Chris Robinson. Have a great day and have a great rest of the week.